I'm Emily Chang, and this is Bloomberg Technology. Coming up, Masayoshi Son doubles down on his quest for U.S. consolidation, with talks for a Sprint T-Mobile tie-up back on the table, and an offer for Charter hanging in the balance. We'll weigh all his options. Plus, the memo nobody missed from Google. A male engineer's manifesto against the company's diversity initiative has gone viral. The backlash from the 10-page rant that hit reset on Silicon Valley's diversity problem. And Netflix rolls the dice on its first acquisition ever. We'll break down its biggest bet yet on superheroes and the plan to begin mining the pages of hit indie comic publisher Millarworld. But first, to our lead. Japanese tech giant SoftBank is back in the spotlight, this time with earnings. Sprint helped SoftBank beat estimates with an operating profit of $4.3 billion. Good news for SoftBank's chairman and CEO Masayoshi Son, who's on the hunt for more deals and investments. The billionaire is in the process of creating the $100 billion Vision Fund to speed up investments in tech startups abroad. The fund was included in the results for the first time. Son says he's mulling various deal options, including a merger between Sprint and rival carrier T-Mobile. Joining us now to explore all of the options in New York, our editor-at-large, Corey Johnson, and here with us, our guest host for the hour, Bob O'Donnell, president of Technalysis Research. So, Bob, when you look at the results, how do you see the story that SoftBank is trying to tell as being this global deal maker playing out?
Well, I think that's exactly what we're seeing Masayoshi Son do. And he's talked about this for years. Ironically, I actually worked for a company that he bought about 25 years ago when he first started this vision of building up media. It was a small high-tech music magazine. But watching him over the years and seeing this vision evolve, he is driving himself to be sort of the tech version of a Warren Buffett in an interesting way. He's creating this conglomerate of all these component companies that he sees as being critically important to drive forward this vision into the future. And I think it's a smart plan. Now, not all the bets are going to work, but I think he's placing them in a lot of good places.
Corey, Masa-san, Warren Buffett of Asia, what do you make of that?
No. Come on, Bob, look, I mean,
come on, Corey.
Warren Buffett's Warren Buffett because he's proven himself to be a successful investor of buying things with low valuations and helping them grow in a sort of quiet way without using a lot of debt. This is the opposite of that. This is taking on enormous amounts of debt with tremendous risk on that debt. If you watch the way the CDOs traded in Sprint over the years, you've seen that investors have looked at this and thought he's near the edge of bankruptcy over and over again. These are big swings for the fences and anything but low valuation. As I said, meant using a lot of debt to do it. I think what's interesting here is he's also trying very much in a Buffett-like way to use politics and to use connections to try to make these deals happen. In particular, think of the image of Masayoshi Son in the Trump Tower visiting President-elect Trump, talking about all the jobs he's going to create with this investment fund that he'd already announced that President-elect Trump didn't seem to have heard about before, but wanted to let him get credit for it. At the same time, he's still thinking about the T-Mobile merger that the Obama administration had said was not going to be good for U.S. consumers. Son perhaps thinking that his appeal to President Trump in particular and his personal appeal might somehow get this deal through, and clearly still talking about this.
Bob, respond. I mean, look, there's a lot of question about whether he can pull off these deals. It's certainly very ambitious.
It is very ambitious. And look, and to be clear, I'm not saying he is a Warren Buffett. I'm saying his goal is to be like a Warren Buffett. But his approach is not
mine, by the way, if anyone's taking score,
Hey, me too.
But his approach isn't on value. His approach is on building and buying these core components. Like, people don't think about the fact that he owns ARM. ARM is this semiconductor IP company that has an incredible amount of influence that most people don't recognize and realize. He's got telecom. He's got internet. He's buying robotics. He's buying a lot of the core technologies that he thinks can drive forward. Now, admittedly, the debt is a big issue, clearly, but I think he's being smart and developing a vision. He has what he calls his 300-year plan. Now, obviously, that's a bit overkill, but even having a 25 or 30-year plan these days is a big deal, and I think he's making bets based on that vision.
Corey, we've been talking about a potential Sprint T-Mobile merger now for years. How do you see this actually playing out?
Well, I think what I'm trying to get my head around is the notion of 5G and what 5G is going to mean, and how the landscape where we've got really more than half of the U.S. mobile phone market is between two companies that are virtually equal in market share in AT&T and Verizon. So trying to compete with AT&T and Verizon is what T-Mobile and Sprint are thinking about. And so, but when it comes to 5G, things can be very different in terms of who's got the spectrum and who doesn't, and that maybe there's a chance to sort of rewrite the market share pie chart that you're looking at right now in a world of 5G. But I think it's also worth noting the comments that Masayoshi Son had this week, which is to say he wants to be number one, is not satisfied being number three. And by the way, look at the rearview mirror, number four is not too far behind. But I think as U.S. consumers, when we think about it in terms of how the government's looking at this, what he wants is to be number one. He doesn't want U.S. consumers to have the best choices. He doesn't want U.S. businesses to have the most options for providers of wireless services that will go far beyond just making calls or getting data. And so we have to think about what it means for what the business changes will be if we have fewer competitors in the U.S. providing a wireless service in a world of 5G, when so many technology businesses will be based on the availability of 5G. And if there are fewer competitors, we know that the prices are going to be higher. And so what's that going to mean for businesses and for consumers going forward? And is the Trump administration going to care about that when they take a look at this deal and might come up with a conclusion different than what the Obama administration saw?
Bob, this wouldn't be just another big tech deal. This is a deal that could impact directly hundreds of millions of customers.
It absolutely could. And clearly, he's going to need to get all of those pieces together, the Charter piece that you mentioned, as well as T-Mo and Sprint, to really be a viable competitor to those other two. And so that's a big question mark if he can really pull it off. I do think in the current administration, there's going to be less of the governmental pressure that you mentioned early on. So it may be that those things are brought to the side. But, Corey raises some good points, right? There clearly are going to be challenges to the consumers, and other governmental entities may still step in on this and just say, no, this is too big to make this kind of a thing happen.
Corey, this is the first time we saw the impact from the $100 billion SoftBank Vision Fund. Of course, that's still being raised, but what did you see in the results in terms of any more indication about how this is going to be spent?
I mean, it's way too early to see what we're going to, the results of running a venture fund under the arm, or under the umbrella of the much larger SoftBank. I mean, what we're going to start to see perhaps is some fees, but it depends on how they're going to recognize those from an accounting basis. But I think that, if you look at the history of Sprint, you see a couple of bets that have paid off fantastically from a venture side of things, whether it was the investment in the game companies in Scandinavia or Alibaba in China or Yahoo Japan. Such great returns from those investments that you can see why he's got stars in his eyes and wants to pull that off again, whether it's managing money from other investors or money from Sprint itself.
Well, we're going to talk about what he had to say about the U.S. ride-hailing business a bit later in the show. Our Bloomberg editor-at-large, Corey Johnson. Thanks so much. Bob O'Donnell of Technalysis, you are sticking with me. Well, Tesla is making its debut in the primary corporate bond market. This comes as Elon Musk bolsters his company's audacious bet on a more affordable electric car. The automaker plans to sell $1.5 billion of bonds to support spending on its new Model 3 electric car. The sale will also bolster its balance sheet. Tesla burned through a record $1.2 billion in cash in the second quarter. Coming up, a Google employee's anti-diversity screed enrages the company and Silicon Valley. Megan Smith, former head of Google X and former CTO of the U.S., joins us next. And Bloomberg Technology is live streaming on Twitter. Check us out at Bloomberg Tech TV. Weekdays, 5 p.m. in New York, 2 p.m. in San Francisco. This is Bloomberg. Alibaba and Marriott are teaming up to tap into a Chinese tourism boom. The companies will set up a joint venture to feature Marriott's hotels on Alibaba's travel site. Marriott has 6,000 hotels, including the Sheraton and the Ritz-Carlton chains. China is now the world's largest source of outbound travelers who've spent more than $100 billion in 2016, spurring changes across the global tourism industry. Now, an internal battle over diversity at Google has gone public. It began when a male engineer sent out a memo arguing that Google has a politically correct monoculture that ignores differences between the sexes, and that there are biological reasons, he argued, for the underrepresentation of women in tech. Now, Google's diversity chief has weighed in. She says the employee made incorrect assumptions about gender, and his views are not endorsed by the company. The argument exposes women's prolonged struggle to make advancements in the tech industry. Only a reported 26 of computer and math jobs are held by women in the U.S. today. Joining us now from Washington, former vice president of Google and former U.S. chief technology officer and advisor to President Obama, Megan Smith. Megan, great to have you here today, especially on this day. My first question is, when you read this, what was your reaction?
You know, it's so offensive to see what this young man was writing, but it's helpful to see it in the public because many of the people working in Silicon Valley are experiencing this kind of microaggression culture that's coming from some of our younger employees, other employees who have these points of view and think that they're correct. They're just incorrect, and it was wonderful to see the reaction. One of wonderful alumni of Google, who's a distinguished engineer, wrote a terrific piece just counteracting every single one of his arguments. But it's there, it's insidious, and so many people, women of all races, men of color, experience what I call a death by 1,000 paper cuts. You know, this stuff is personal, it sort of comes at you, it's insidious, and it's all around the culture. And then when you're getting it, it's so personal, it's hard, and it's agile. It's hard to understand it as a pattern, but it's almost class action if you can see the pattern.
So, look, you're an engineer yourself. For anybody out there who believes that there are biological reasons for the underrepresentation of women in engineering, please put this to rest.
Yeah, it's a lot of mythology. I was lucky to go to MIT in mechanical engineering, and Chuck Vest, who was president of the university, ran a study with a lot of the university in the 90s. And one of the things he wrote at the intro of that is when they showed all the discrimination that was happening, both who gets recorded in history, who gets what promotions, who gets what lab sizes, who gets what kind of funding for their research, et cetera. He said, I always thought it was part myth and part reality. He said, I've learned from this study that's almost all reality. And we really need to work on this and change this because, of course, we want all of our talent. We want to play the whole American team, especially in Silicon Valley on these incredibly exciting tools and platforms and culture. The culture is so wonderful in Silicon Valley, and this isn't unique to Google, this challenge of this young engineer. It's across all of the companies. It's rampant. And so we just have to keep working on this through the diversity work, and people are doing the work. You see Brian Chesney and the teams at Intel doing a great job, Apple, Facebook, others. Google has a lot of programs. We just have to be more vigilant. The most important thing here is that we need to move the priority up and directly address these kinds of challenges when they come and help these engineers evolve. You know, they are misguided and they're destructive to their colleagues. It causes people to leave the industry, and it's bad for shareholder value. You know, we know that more diverse teams make better products, have better results. So we want the genetic flourishing of all humanity, all the Americans, all the people of the world in on making these products, especially as we move to AI and data science. These are very powerful. We don't want to write this discrimination, racism, ageism, sexism into our algorithms, which is what can happen very easily if we don't nip this stuff in the bud as it appears.
This engineer himself makes a point that Google should value diversity of opinion, ideological diversity. Erica Baker, a former Google engineer, believes that the real news is that he felt safe enough to write this. There are a lot of people asking why this guy still has a job. What kind of action should Google take here? Should this engineer be fired?
You know, I won't weigh in on that, but he should. There should be a very specific conversation with him and with others and with the company around this, because I think as Erica's memo and also Kate Houston and the other members are pointing out, he's acting as if it normalizes this kind of sexist, racist, ism type conversation, which is just all the facts are wrong in his memo. You know, there are moments of reality and you know, factual elements that are in there, but then he pulls out a conclusion that is just factually incorrect. And so we just have to catch that. You know, it's up to Google what they do, but I think the main thing is having open conversations. There's freedom of speech in our country. We value that. Here we are in the press. We value that so much, but we also, you know, have social norms about things, and there really are rules about inclusion and disinclusion, and our minds have evolved. We're right near the Jefferson Memorial. You know, Thomas Jefferson, one of the quotes on the wall here says, you know, I'm not a fan of the rapid change of law, but as the human mind evolves, we learn new things, you know, and we can no longer wear the coat that fit us as a boy. And so racism, sexism, ageism, homophobia, all these things we know that they have been rampant in our culture in the hundreds of years in past. None of us created them, but we all inherit them, and it behooves the tech industry and everybody to step right up. This is our moment to evolve out of this and lead the world with these incredible technical skills that we have. Tech can move so fast, and if it chooses to prioritize this higher and use its own technical skills and methods, we could probably move out of this much faster as a human society.
On that note, you know, sometimes it seems like 2 steps forward, 10 steps back. You're part of this tech jobs tour that's happening right now where you're trying to visit 50 cities, fill 100,000 open jobs. You know, when you're out there in the country, how big are the challenges you're still seeing to women truly making advances in technology and filling these jobs?
The problems are everywhere, but what's exciting about the Tech Jobs Tour, if you go to techjobstour.com, we'll be in San Francisco this week. We're just in Memphis, Cleveland, Birmingham, just across the country. We show up. It's like a career fair meets kind of a revival. At night, you've got companies there recruiting. You've got these new code boot camps and apprentice programs that are, you know, a couple months straight into this higher paying jobs. The tech jobs pay 50% more than the average American salary, and the companies are starving for these people all over the country. So we're really on this, this tour to just put together the tech communities, the businesses, the government leaders, and all of the great talent that's around our country and get them together in the evening in these cities as we come together. We'll be in Milwaukee. Shortly we'll be in West Virginia and across Kentucky. I was just in Appalachia with wonderful coal miners who are graduating from boot camp. There were 1,000 coal miners who tried for 50 slots. Fabulous work. We can kind of reshore, like offshore, we can reshore a lot of these jobs into the rural parts of the country, into other places. Great new startups all over. You know, the Memphis team, we saw one of my favorite ones was people had taken a container, you know, those containers on the container ships, put STEM work stuff in there, put it down by the Mississippi near a playground, and young people were in learning coding and tech and Internet of Things inside of this place. It was fabulous. One guy had built his own portable sound studios, so just wonderful entrepreneurs all around the country, whether it's enterprise tech, which we saw in Cleveland, or whether it's more music tech there. So it's great stuff.
Megan Smith, former U.S. CTO, former VP of Google X. Megan, thanks so much for joining us today. Coming up, we'll have highlights from our exclusive interview with French Finance Minister Bruno Le Maire, why he is promising a big change in the tax system across the EU. This is Bloomberg. Tech giants from Alphabet to Facebook and Amazon have taken advantage of tax loopholes in Europe, lowering costs and grabbing market share from local competitors. But speaking exclusively to Bloomberg's Caroline Connon, France Finance Minister Bruno Le Maire said the country is gearing up to propose new rules that could have big implications for the tech industry.
It's always the same strategy based on level playing fields, based on the same rules for everybody. When you are doing business in France or in Europe, you have to pay taxes. You cannot take the benefit of doing a business in France or in Europe without paying the taxes that other companies, French or European companies, are paying in Europe or in France. The same rules for all the companies and for all states.
Does that mean that you want to lower the corporate tax to 25% everywhere in the Eurozone?
We will lower the corporate tax from 33% to 25% till 2022. And then, this is the second step, we want to have a tax harmonization among the members of the Eurozone. You have 19 members of the Eurozone. You have one currency, the euro, and you have 19 levels of taxes, and you have 19 different economic policies. We cannot go this way anymore. That's why we are advocating for tax harmonization. The first step of the tax harmonization at the European level will be a tax harmonization between France and Germany. And I'm quite convinced that no later than 2018, we should be able, with Germany, to have a common corporate tax, which should be the basis for a harmonization of all corporate taxes at the level of the 19 member states of the Eurozone.
What concessions do you expect from the Germans in order to further this European integration? And in exchange, would you accept a German as the head of the ECB, for example?
Be a little bit patient. We are in 2017 and the decision must be taken in 2019. So it means that we still have some time before deciding who will be the next chair of the ECB. But we should not wait before taking decisions as far as the integration of the Eurozone is concerned. I really think that we should be able, at the end of 2017, to make a first step towards more integration within the Eurozone.
That was French Economy and Finance Minister Bruno Le Maire in an exclusive interview with Bloomberg's Carolyn Connon. Coming up, Masayoshi Son wants in on the U.S. ride-hailing market. Will the company back Uber or rival Lyft? We'll break it down next. This is Bloomberg.
I'm Mark Crumpton in New York. You're watching Bloomberg Technology. Let's begin with a check of your first word news. The European Union has notified food safety authorities in Britain, France, Sweden, and Switzerland as a precautionary measure that some eggs contaminated with an insecticide might have entered their territory. The European Commission said today that Germany and the Netherlands notified the EU's food safety alert system over the weekend.
They notified the system just to alert and to share the information so that everybody knows that it's now also up to the Swedish, Swiss, French and to the UK national authorities to check, because all these eggs are traceable.
Jordan's King Abdullah held talks with Palestinian Authority President Mahmoud Abbas in Ramallah today. His West Bank visit is his first in 5 years, and it comes at a time of rising Israeli-Jordanian and Israeli-Palestinian tensions at a Jerusalem shrine, known to Muslims as the Noble Sanctuary and to Jews as the Temple Mount. And Kenyans vote tomorrow in one of the most competitive presidential races in its history. Incumbent Uhuru Kenyatta faces longtime opposition leader Raila Odinga. The success of the Independent Election Board's computerized voting system is key to ensuring the process is free and fair. The man in charge of the system was found strangled last week. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg. It's just after 5:30 p.m. here in New York, 5:30 a.m. in the West Australian mining city of Kalgoorlie, where we're joined by Bloomberg's Paul Allen, who's there for the annual Diggers and Dealers Conference. Paul, good morning.
Good morning, Mark. Yes, well, I am in a mining town, so let's start with iron ore, which is surging overnight. Take a look at the SGX Asia Clear Index iron ore hitting $75.63 per tonne, wiping out all of its losses from 2017, and rebar on the Shanghai Futures Exchange also hit limit up, and this is as China closes mills and government stimulus as well, and likely pollution curbs coming in over the winter. So later today we'll be hearing from Fortescue Metals CEO Nev Power. He is the head of Australia's largest pure iron ore play. Elsewhere around the market, ASX futures up 0.2%, so looking positive there. Nikkei futures also up as we wait on earnings from Tokyo Marine and Olympus, and also the balance of payments for June out of Japan also expected, and China trade. So a busy day here. I'm Paul Allen in Kalgoorlie. More from Bloomberg Technology next.
This is Bloomberg Technology. I'm Emily Chang. Back to our top story. SoftBank and its global ambition to become a major tech deal maker. In an announcement after earnings were reported on Monday, Masayoshi Son confirmed his interest in the U.S. ride-hailing market. Take a listen.
We are interested in discussing with Uber. We are also interested in discussing with Lyft. We have not decided which way. But the U.S. is a very big market. It's the most important market. So we are definitely very much interested in the U.S. market.
SoftBank already backs China's Didi Chuxing, India's Ola, and Grab in Southeast Asia. Joining me now to discuss, Bloomberg's Caroline Hyde out in London, and with us here in the studio, Technalysis Research President and guest host for the hour, Bob O'Donnell. So, Bob, let's start with you. Look, ambitious as ever, yet he's already made investments in all of these other ride-hailing companies. There was talk he might be trying to create some sort of anti-Uber alliance. Then we heard he was interested in getting Uber shares. What do you make of this?
Well, two things. First of all, he's doing his deal making in public, so he's trying to prove himself to be this master dealman. And again, he's trying to build these component core technology pieces. And the interesting piece that he wants to deal with is the notion of autonomous driving, which we believe is primarily going to affect fleets like these car sharing companies. So if he can develop some technology and then leverage it across all of the different ride-sharing companies, he has a big opportunity to influence that market in a much bigger way than a lot of people may realize at first.
So, Caroline, we had reported that SoftBank was interested in potentially acquiring secondary shares of Uber. Then there were reports that deal was not happening. What do we know about the status of SoftBank's actual, investment or talks about investing in these two companies?
I know, so convoluted, because we had understood that it was going to be Uber he was initially after. You said it. He wanted in, perhaps buying from the secondary market. The likes of Benchmark Capital, which is one of the first investors in Uber, was said to be one of the driving forces behind perhaps selling some of its stake into SoftBank. Then SoftBank potentially also wanted to get in at the $70 billion valuation of Uber with those seats on the board. Then that all seemed to fizzle out. Reports around the market seem to show now it's a Lyft and an Uber race. He says he hasn't decided. What different companies, though? Lyft, the last time it raised money, was about $7 billion valuation, and we know that Uber is about 10 times that. And what's so interesting is on both parts, he's going to be getting into bed with either companies in his portfolio already, because Didi Chuxing, the Chinese company that he backs, is an investor in Lyft. Meanwhile, Uber's one of prime investors is actually someone who's backing his enormous vision fund, the $100 billion or almost thereabout vision fund, that being, of course, the likes of a big wealth fund backed by Saudi Arabia. So it's interesting as to which mark he takes, but I do think it's notable that he says he wants to be the world's most valuable company, that being SoftBank, and he wants to have the biggest investment portfolio in technology, and he's got to get in to autonomous vehicles and ride sharing. In particular, he didn't really speak about the autonomous element of things. Have a listen.
I think the way people use the transportation and the lifestyle will be different from today, 30 years later, 50 years later. It will be very different. Autonomous car is definitely coming, and when that stage comes, this rideshare business becomes even more important.
He's going to back any horse it seems to win, Emily.
All right, Caroline. So, Bob, it's interesting. I wonder if this sets off now a race between Uber and Lyft, because in this, neither of them are public companies. They need more funding to continue to grow and compete with each other, right, as well as compete globally. Does this set off, an increased competition between the two of them when it comes to potentially billions of dollars.
Well, I think it does. I mean, clearly my guess is he wanted to go with Uber, and that's why he was placing all his bets there. But given all the challenges they've had, I think he's realized that, you know, maybe there is this interesting opportunity and he can do something to drive Lyft forward and still play a role. Again, his view is long term. He wants to see who can drive this autonomous vehicle technology and then share that across other ride-sharing companies. And oh, by the way, leverage the semiconductor companies like NVIDIA and ARM and all these other companies that he already owns a piece of and build that into this bigger vision. Again, around the Vision Fund, leveraging the Vision Fund as well.
All right, Bob O'Donnell, we will keep a close eye on all of Masayoshi Son's deal making. You are sticking with me. Bloomberg's Caroline Hyde out with us in London. Caroline, as always, thank you. Now, sticking with SoftBank, the Japanese giant acquired ARM Holdings just last year, as Bob mentioned. The company posted a quarterly loss due to an increase in headcount, compensation, and a one-time acquisition charge. Net sales for the past quarter reached $428 million, up from $409 million the previous quarter. The results included a $120 million in expenses recorded following the acquisition. Coming up, WeWork expanding again, this time targeting Southeast Asia and South Korea. We'll explore the shared workspace startup's global ambition next. This is Bloomberg. It's such an interesting new world.
The world is changing.
For us, it's not about being first, it's about being the best.
A lot will change over the next 5 years.
We feel like we can maybe help people out more.
I see the stock price flying sky high.
All the people that work here, we know we have a very big responsibility, and we want Facebook to help do good in the world.
WeWork is continuing its global expansion, this time centering on Southeast Asia and South Korea. The world's largest provider of shared workspaces says it'll invest $500 million in the region and will acquire SpaceMob, a Singapore-based co-working startup. The latest move comes on the heels of WeWork's announcements to expand into China, Japan, and a third WeLive location in Seattle. Joining me now to discuss this and other challenges, the road ahead for WeWork, Bloomberg Tech's Selena Wang in New York, and our guest host for the hour, Technalysis Research President Bob O'Donnell. So, Selena, I'll start with you. Talk to us about the strategy here and why WeWork is making these moves.
This is pretty interesting because the acquisition of SpaceMob is actually the first time WeWork has outright and acquired another type of co-working space. All of the previous acquisitions have been for related services. And so with this acquisition, which likely was not very large, they're getting a local team and people with local expertise. SpaceMob is based in Singapore. Now, the company says that they very much wanted to do this acquisition for the talent and that local expertise. And they've been expanding incredibly rapidly. And as you said earlier, they're really taking this approach where they're finding people who are already there, have the expertise, and finding investors together so they can rapidly scale in the region.
Now, I actually interviewed the head of SpaceMob at the end of last year before this acquisition happened. Take a listen to what he had to say.
Lines are blurring, especially when co-working is being offered to traditionally more entrepreneurs, more SMEs. But even the corporates are looking at co-working as well right now. This is a way for them essentially to save capex, a way for them to be flexible, a way for them to basically learn how to be nimble as small companies. So we are helping companies small to become big and big companies to remain small and nimble at the same time.
Bob, how optimistic are you about this co-working space trend? $20 billion.
It's impressive that they've gotten this far, but I have to tell you, I've done research on this, and there are a lot of concerns that people have once they've started to actually do this. Because what you find, for example, is they're very noisy environments, and it's hard to get work done in a lot of these places. So when I looked at trends of where people expected to be working over time, those WeWork type situations were growing, but then stalling. And that's the concern. And the other big concern is this has traditionally been a U.S. Business or tech-focused kind of attraction. In other words, you find a lot of U.S.-based tech companies working in these environments. Whether that can transfer culturally and into other industries remains to be seen.
Right. Tech startups aren't the only kinds of new businesses out there. Selena, how is WeWork addressing some of these concerns?
Well, WeWork has a very high valuation. As you said, they need to live up to that, and part of it is by
rapidly expanding globally with partnerships with people with a lot of capital, like Honey Capital in China, SoftBank in Japan. Now, a lot of the concerns are that this is kind of a cyclical business. When tech and startups are doing well, WeWork is going to have a lot of business. So they've also made some changes in their strategy to incorporate more enterprises and large businesses like a Microsoft that wants some extra flexible working space. And so they're really trying to diversify their revenue streams not only globally, but also with their existing co-working strategy.
And there are competitors out there. You know, WeWork has partnered with SoftBank and Honey Capital, which is a Chinese investor, to expand into Asia. But there's a big Chinese competitor, right? Your work. Tell us a little bit about, you know, the differences between the two.
Right, Your Work is a big competitor. It's homegrown. They've grown incredibly rapidly, have raised billions of yuan, and have a lot of local investors that are very well connected in that area. Now, WeWork is very much aware of this big competitor, and they're hoping that with the help of Honey, with the help of SoftBank, they have enough capital to win all of these customers. Now, it's a very similar model, but Your Work in China, the price is a little bit less, but it's a very similar concept, very similar idea of these nice, beautiful working spaces. You rent out these desks. So I think it's really up to the amount of capital they can put into it, and if they can successfully leverage the local folks they have there as well as their partners, because as we've seen in the past, not all of the U.S. companies that have taken this partnership and localization approach even have succeeded.
And it's interesting to note that they're doubling down with WeLive, the co-living business. We will keep watching how this plays out. Bloomberg's Selena Wang in New York. Thank you. Our guest host for the hour, Bob O'Donnell of Technalysis. You're sticking with me. Well, Earnest is on the lookout for a buyer. The financial technology startup is working with Barclays in hopes of securing bids of around $200 million. This, according to people familiar with the matter. The move comes as the online lending industry as a whole has been hit with a number of setbacks in both the public and private markets. Backed by venture capital firms, including Andreessen Horowitz, Earnest has raised just over $300 million since it was founded in 2013, receiving its most recent funding of $9.8 million in March. Coming up, a move that is 20 years in the making. Why Netflix decided a comic book publisher was the right fit for its first acquisition next. This is Bloomberg. The Dow posted another record high today, gaining for the 10th straight session. One stock, though, that's failed to fully join this historic run is Disney. Investor concerns about its media unit are weighing down the stock's gains. Bloomberg's Scarlet Fu takes a look at the company in The Numbers Don't Lie.
The Walt Disney Company will be reporting earnings after Tuesday's U.S. closing bell. The House of Mouse released Guardians of the Galaxy Volume 2 last quarter. That movie raked in more than $860 million worldwide. Disney hopes its movie and theme park businesses offset any weakness in its media unit. Let's take a look at Disney in today's The Numbers Don't Lie. We start with how Disney's revenue breaks down. You hear a lot about how its media networks unit is the big one because that unit represents the biggest slice of the pie. It is the orange slice right there at more than 40%. The runner-up is Disney's theme parks, followed by the movie studio, and then consumer products, which is the red slice. Now, Disney's ESPN is under massive scrutiny due to its subscriber losses. In the past 3 years, ESPN has lost 9 million subscribers, even when factoring in TV over internet services. More recently, when you look at just the month of June, this past June, yes, streaming content is helping to slow some losses, but ESPN still lost subscribers in that month. Now, CEO Bob Iger last quarter said the pessimism surrounding ESPN was highly exaggerated. Some of that is reflected in Disney's stock, which has fallen recently due to renewed industry concerns on fewer viewers and lower ad revenue. Disney's total day cable ratings fell 18% in the month of June, and there are reports that TV networks are bracing for a drop in ad revenue for football games for the upcoming season. So perfect timing then that Disney's theme parks are doing better. And a big driver for that unit is the Shanghai Disneyland Resort. Even though it's just more than a year old, that park is now the 4th most popular one across Asia. Disney's movie studio has released a number of hits, but it is facing tough year-ago comparisons. This earnings period covers, of course, Guardians, Pirates of the Caribbean, and Cars 3. Now, later this year, much to a lot of people's anticipation, Disney will release the latest Thor and Star Wars movies. Disney hopes these movies offset some of the concerns over its media unit. The stock so far has not joined the record double-digit rally we've seen in the Dow Industrials. We'll get a better sense of Disney's prospects after Tuesday's U.S. closing bell.
That was Bloomberg's Scarlett Fu. Make sure to tune in Tuesday right here on Bloomberg Technology. Disney CEO Bob Iger will be joining us, talking with our very own David Weston. Well, from one media giant to another, Netflix has made its very first acquisition. The streaming video company announced it's snapped up Miller World, a comic book publisher behind characters and stories like Kingsman and Old Man Logan. The acquisition is Netflix's latest move to bolster its own content instead of just licensing it. This as rival media companies like Sony and Disney become wary of providing content to streaming services, as popularity of sites like Netflix looms as a major threat. Joining us now from LA, our Bloomberg reporter Lucas Shaw, and still with me, Technalysis Research President Bob O'Donnell. Lucas, I'll start with you. Of all the acquisitions out there, why Miller World as their first buy?
A big part of it, coming off that Disney segment, is because Disney, Time Warner, they already have these pipelines of comic book materials from which they can use, and right now all of the TV shows and movies that Netflix offers on its service or at least most of them are from Disney. They're TV shows that Marvel owns and produces. They're movies that Netflix licenses after they appear in theaters, and Netflix wants its own pipeline of original comic book materials that it can develop, it can own, it can exploit down the road if it wants to make T-shirts or lunchboxes or a theme park ride.
Bob, what's your take? Is this a smart deal?
I think it is, because I think what we're seeing is, you mentioned it, you mentioned Netflix as a media company, right? That's different than Netflix as a streaming company. And for them to become a media company, they have to buy and create this original content. If you want to create stickiness in your service, that's the kind of move you have to make. We see this with Amazon doing that for their Prime Video service, with Netflix doing this. I expect we'll see more of this. And I also expect that this is a bit of a challenge for a company like Apple, who's talked about doing this, because it's not clear what their commitment is there yet.
You know, it's interesting because when I spoke with Tim Cook after earnings last week, I asked him about their video and original content efforts, and he said, again, it's very, very experimental. You know, what do you think this means, Lucas, for other big media players and perhaps some unconventional players, a tech giant like Apple?
I think the traditional guys, you know, your Disney, Fox, Time Warner, CBS, Viacom, are very, you know, they're intrigued by this. They're not quite sure what to make of it. I had a couple of different people I spoke with today try to ask me to explain it. You know, Netflix has never bought anything before. As you said, this seems like a little bit of an outlier. It doesn't necessarily mean they're going to be out there buying a bunch of libraries, but it opens the door to that possibility. And it just reinforces that Netflix wants to be ready for a world where no one's going to license them a whole lot. You know, we've seen these big companies gradually retrench and revise their strategy because they felt like they were giving some of their most valuable IP away to let Netflix build its service. As for the new players, you know, we report obsessively on companies like Apple and Facebook and Google and what they're doing, but we've really reached a point where in terms of media creation, production, ownership, development, Netflix and Amazon are really on another plane from those companies. You know, Netflix and Amazon are making as much TV as the biggest media companies out there. They're streaming it all over the world. Apple and Facebook and those guys are still dipping their toes.
Hulu just had its first hit, The Handmaid's Tale, after many, many years of trying in original content. Does the fact that Amazon and Netflix, Bob, are so far ahead mean nobody else stands a chance?
No, I still think there's opportunity.
If they invest billions of dollars, well, certainly.
The content creation business is tough, right? I mean, there's decades of history of how difficult it is to make that a successful business, and it's a hard skill to acquire. And clearly, you're seeing a lot of efforts, a lot more of the tech industry, you know, marrying up with Hollywood and other places around the world, Bollywood, where have you, to try and come up with compelling original content. Because ultimately, as he said, you know, the notion of all of that content being given to Netflix for them to, not given, but licensed to Netflix to use, that may go away. So they have to be prepared if they want to survive long term as a media company, and we have to start thinking of them in that regard.
All right, Bob O'Donnell, president of Technalysis, thank you so much for joining us. Lucas Shaw, our Bloomberg reporter in Hollywood, thank you as always. That does it for this edition of Bloomberg Technology. Remember, we're live streaming on Twitter. Check us out at Bloomberg Tech TV, weekdays 5 p.m. in New York, 2 p.m. in San Francisco. That is all for now. This is Bloomberg.